All right, you guys, this is being recorded. I mentioned at the beginning of every single webinar, watch this again relatively soon afterwards. We usually send this out, or you can find it on our YouTube channel and or our Facebook channel as well. So we usually put these out shortly thereafter so you can kind of get a review on it. It'll help it sink into your long-term memory there. This is going to be on implementation of options into our portfolio, and it's a little bit different than just trading options. You know, a lot of times I do these short put webinars on how to trade a short put, but you know, that also requires a level 4 options clearance. If we don't have that, if you're newer to trading, you have a portfolio that you want to use this as dollar cost averaging, which is what I highly suggest using short puts for, rather than going out there and just putting a bid in the market to buy stock. I would highly suggest going out there and doing short puts. So if you have that, you could, or if that's something that's interesting to you, and you want to use this for dollar cost averaging, you know, to get level 1's relatively easy for options, but then it's going to be a cash secured put. All right, so very similar in nature, but the way that we're going to be talking about implementing this strategy into our portfolio is going to be, you know, based on the theory that we have a portfolio that we're building out of stock and not necessarily a short-term trade for that matter. All right, so keep that in mind as well. Let me get over a couple of things. My name is Eric Wilkinson. For some of you newer people that may or may not recognize me from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree, and then switched over to finance. After graduating college, I moved straight up to Chicago and started working on the floor of the Board of Trade. In that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all these products in just about all market conditions. Also, I want to have you guys pause here for a second. We got to go over this disclaimer because it really is important. This webinar is for informational purposes only. It does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, I don't know your risk parameters. I don't know what's in your portfolios. And you guys, I don't want you guys to just limbing off the cliff with me. I don't like the herd mentality. I want to teach you guys how to think for yourselves, all right? My directional assumptions on things might very well be completely different than what yours are, and you might very well have better directional assumption than I do. So make sure you take that into mind as well. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, I mentioned this. You guys can follow us on Twitter. Myself personally is at Wolfman's blog, and our parent company is at ProTraderStrat. Facebook page you can follow is at ProTraderStrategies.com. So like us on Facebook so that you can get access to, you know, some of the daily market commentaries I'm doing and other videos out there as well. So we're always pushing out different content on Facebook. So make sure you're a part of that. All right, like I said, this is on the short put or the cash secured put. All right, we're going to be looking at both of these. Cash secured put. One of the things with the cash secured put, you guys, you're going to have to put up a lot for margin when you only have those level 1 security clearances. If you have it up to a level 4, you don't have to worry about it. You can still trade it the same way and use it as a surrogate for dollar cost averaging. It'll also help us lower our overall basis. Just know that if you're only level 1s, it's going to be considered a cash secured put, and you're basically going to have to put up full boat for it for the most part. All right, so we need to go over what our risk parameters are with the short put. Our max profit is basically our premium received. Anytime you collect a credit, that is going to be, and I have commissions on there. We don't have to worry about commissions so much anymore. I guess you still do with the options, but they are a little bit less now. But anyway, the premium you received is really going to be your max profit on this. Our max loss, though, is if this goes to 0, right? If we buy a stock at, let's say, 500 and it goes to zero, well, your max profit is, or your max loss is still going to be to zero there. So it's going to be very similar if we're trying to go out and buy a stock and it goes to zero. One thing people don't really like to correlate is, well, it's the same thing with puts, you guys. If you sell a put in this market and that underlying goes to zero, well, you made that decision to go out there and buy that stock at a certain level, even though it's below where the market's currently trading. You kind of have to hold yourself accountable for that. It's no different with the short put, you guys. If it goes through our strike, that is where we had planned to buy it anyway. So that's the mentality going into this. If I'm selling the 60 put and this underlying goes down to 55, well, I bought it at 60. Well, what's the difference between if I put in a bid to buy the underlying at 60 and it goes to 55? We don't always look at it the same way. Well, I own the stock and I decided to buy it at 60 and it went to 55. You really aren't as angry at yourself as a lot of people get when they sell some puts. They're like, oh, I should have never sold those puts. Well, you said you were going to buy it there anyway. So that's the mentality we're going into this. Is we're looking at an underlying. We want to buy this stock to put it into our portfolio. And if it never comes down there, well, then we get to keep that credit that we sold that put for. You know, that's the benefit of selling the put versus putting in a limit order to buy a stock, is that, you know, if it never goes down there to where your stock was, well, or where your limit order was, well, you never got to buy anything. You never got anything for it. It was just out there in the market, right? You were just taking risk. This, at least you're getting paid for taking that risk. And that's the difference here. And that's why I would suggest using the short put rather than a limit order for dollar cost averaging. Or even if you just decided, for instance, hey, you know, now that Tesla blasted off, I'm only mentioning Tesla because we were talking about that before the start of the webinar. You know, now that Tesla's up at around 600, well, I'd love to buy it at 500. Well, all right, well, then we can start selling some puts around there rather than put in a limit order to just buy it at 500. All right. All right. So a break even, though, is when the underlying price reaches our short put strike minus that premium received. So, you know, I threw out an example. Let's just say, you know, XYZ is trading 70 right now. So right now, XYZ is trading 70, and I go out and I sell these 60 puts. All right. Well, I sell the 60 puts and I get a credit of, let's say, 50 cents. All right. Well, now my break even is that 60 put minus that 50 cents. Right. So my break even is $59.50. Now, in that example, also, if you're using cash secured puts, you're going to have to put up the $59, or, you know, the $5,950, because it's basically like buying 100 of the underlying. They're going to make you put up the full boat for this. So keep that in mind as well. So but the break even right there is $59.50, and that's basically where you are going to have to put up the margin for a cash secured put. You'll still get to keep that credit though. All right, so our essentials to success is picking the right underlying. You know, especially because some of you guys are newer to options trading, I want to make sure that you guys are picking the right underlyings to do this. You can't like just do it and everything. You know, you can't do it in Casper, that stock that just came out today for the betting. You know, and not all stocks are going to fit this rule, but any stock that is under $100, we need to check and make sure that it is equal to or less than 10 cents wide to the bid offer on the option montage. And all of this is the option montage. So we got a stock that's under $100. We need to check here and make sure that they are less than 10 cents wide to the bid ask. And you can see that right now, Activision's not fitting that rule, but this also needs to be looked at during open market operations. We could probably find something else that fits that rule, like something that's under $100, which I don't even know what this is right there. Wells Fargo, it's under $100 stock. You can see even after hours, it's fitting that rule. It's less than 10 cents wide to the bid ask. As a matter of fact, it's about 4 cents or less. So that would be something that we would be able to trade these options around. The reason why is because I don't want you to have to give up too much edge to get in. You'll have a tendency to get in, you know, where you're selling it way too cheap, okay? Another thing I suggest is you guys, when you're putting in orders for options, and I haven't mentioned this in quite some time, you guys should have at least a couple of cancel replace orders every time you put in a trade. You know, for instance, if I wanted to sell these 45 puts, I would put in a 30, you know, if it was, especially if it was a little bit wider, but I'd start out at 35 cents. That's not going to hurt. And then I'm not saying you sit there and watch it for 15 minutes, but put it in there, let it breathe for a second. By the time you put that order in there, go check the market, come back to monitor page, cancel replace, put it in at 34 cents, let it sit for just a, you know, maybe a minute or something like that, and wait for it to get hit, okay? But a couple of cancel replaces is always really good. You know, Disney is something that is over $100 stock. You can see I'm doing covered calls on a synthetic long in Disney in this, so I'm not trying to get you guys limbing off the cliff. But on a stock that is over $100, you know, we're looking at the closest to 35 days to expiration for this. So you can, one of the things is 35 days to expiration is this where we're looking for this rule. Any stock over $100, move your decimal 3 ticks to the left, and we're looking at 14 cents. All right. So I look down here at the option montage on these options that are just out of the money and make sure that they are fitting that rule of about 14 cents to the bid offer. You can see that for the most part, it's fitting that rule. All right. So you don't have to have it every single strike fitting that rule, and know that the ones that are deeper in the money here are going to get very wide. But the idea here is when you have the tight bid ask, you are going to have a lot of eyeballs on this market, and everybody with free market price discovery is trying to keep their market at least represented. Meaning if I'm at $2.79 and you come in at $2.77, right? Well, now all of a sudden I'm like, I'm off the market. I've got to, you know, either join that $2.77 offer to get out or to make my trade represented, or try and make it a little bit tighter. And when there's a lot of eyeballs on there, that's what happens with free market price discovery. So especially when you're newer to trading and trying to figure out the whole strategy about trying to put these on, you know, I don't want you to give up too much edge on that stuff. All right. So make sure you're taking advantage of that. All right. So we've got that right. Anything that's less than, if it's less than $100 stock, then it needs to be about equal to or less than 10 cents wide for the bid ask, the bid offer. And if it's greater than $100 stock, if it's greater than $100, then we move the decimal. So it's got to be equal to or less than my rule of moving 3 decimal places to the left. All right. Pretty simple so far, right? All right, picking the right strike. Now, when I'm talking about using this as a trade, or you have a bullish assumption and you just really don't want to get hit on these puts, I'm always talking about using the 16 delta. So that is something we can start at, is looking at that 16 delta. If you're newer to trader and you're getting less than, let's say, 30 cents for this 16 delta, I would say, you know, walk away from it. All right. So you want to at least collect around 30 cents for this. So like if you're looking at a $10 stock, you probably aren't going to be able to fit this rule. And, you know, you might have to be a little bit more aggressive on your collection. So it's the starting point is what we're really looking at for this delta idea. Also, if you want to buy that stock for your portfolio and your cash secured puts, the other thing we could say is we're looking for a 10% correction. I'm not going to have enough room to write in there, but a 10% correction is a great spot for dollar cost averaging. You know, it's a rarer occurrence. And you will notice that a lot of times that 10% correction will line up with about the 16 delta. So either one of those will work. I usually, when I'm trying to do a dollar cost average idea, is when I've decided to put this strategy on, I'm looking for a 10% correction to start doing some dollar cost averaging. So that's where I would start with my strike location. One of the reasons why we're using that 16 delta is if we look at this bell curve right here, that's the 1 standard deviation move. We got this bell curve. It means that basically 84% of the time it's going to end up outside here. And when we're looking at that 16 delta, you can add up all of these probabilities, and that's going to end up being very close to, and once you get to the -4 standard deviation and all of that stuff, all of that adds up to about 16% of the time. So, a little floor trader hack is, and something to know with delta, is that delta is also equal, I shouldn't have done the arrow there, but delta is basically equal to probability, or your percent probability of being in the money, right? So if I'm selling a 16 delta, I only have about a 16% probability of that happening. It's not like I want to buy a dollar cost average every single month either, right? I mean, you would have to have a lot of money sitting on the sidelines in order to do that, and then you're going to end up getting overweight in one particular stock anyway. But the fact of the matter is we want to maybe get hit on this every so often when there's been a major correction or something like that. That's when we're going to look to add that in there, because usually that's when it's a great buying opportunity in my eyes. All right, the duration. I don't want to go out there and be like the guy that puts in an order to buy Tesla at 300 and leave it in there for a year, right? I want to stay consistent with this. I want to do the 35 days to expiration, 35 days to expiration, or as close to, we want to be close to ish, 35 days to expiration ish, right? Let's do that. So whatever's closest to that, sometimes you're going to be doing like the 25 days to expiration or something like that. Sometimes you're going to be doing 45 days to expiration, but as close to in and around that 35 days to expiration as we can, because we want to take advantage of theta decay just the same as we would if it was a trade. So some of these are applicable to a bullish trade for selling puts or these dollar cost averaging type things. All right. So 35 days to expiration is right here, and you can see that we have this massive theta decay happening. So the idea here is if we don't get hit on these puts, then I at least get another, I get a credit every time I do it. It's kind of like getting an extra little dividend. And if you already own some of these stock, let's just say, if you have 200 of these stock, then you have 200 XYZ. I would probably start out with, if I was just getting used to this, I'd probably be starting out with 1 lots in the option, all right? So you want to sell 1 option. And the reason why is 1 option is equivalent to 100 contracts, all right? So we're going to start dollar cost averaging it that way. If you have 1,000 of these underlyings on, then you probably want to be looking at probably 2 or 3 and up to 5. I wouldn't always be trying to double up on these for the dollar cost averaging, because it could continue to roll down, and that's where you're going to go out. If you got hit on these puts for an increase of 1/3 of your position, then sell some more puts further down the road and further down the scale. So and you'll be able to continue to dollar cost average that way. Obviously, you like the stock when you're doing this. It's not like you're doing this on a stock you dislike and you're bearish in it, right? But this is when we're taking a portfolio. We're constantly trying to build that portfolio value out. All right. Now, excuse me. Thought I was going to sneeze. All right. So picking the right environment. This is very, very, very important when we're just looking at doing short puts for a bullish market assumption. If I had a bullish market assumption in something and I wanted to just take advantage of high implied volatility or a directional assumption, then my environment would be the same as what I'm talking about selling puts. You want to have the ID percent, we want ID percent to be greater than 50%, ID percent greater than 50%. All right. With this one, though, I'm not going to be nearly as concerned about that. If, implied volatility is at 0, right? Implied volatility percent is, below 10 or something like that, you're going to have a difficult time getting very far that 10% correction and get a collection of credit. But it's still possible, don't get me wrong. And if we are going to stay mechanical with this strategy by building out our portfolio, the IV percent is going to be less of a factor in my eyes. I am looking for strike location, a correction, and adding this to my portfolio. Okay, so I'm specifically trying to go at this webinar as we are trying to add stock to our portfolio. All right, so ID percent in this regard is going to be relatively something that I'm not worried about. What I'm going to be really worried about is having something that has some theta decay and the ability to take advantage of that volatility coming out, right? I ultimately would rather collect the credit in my eyes, but every once in a while when it makes that big move, then I want to be able to scoop it up on a sell-off, right? And when you're ahead of the game, you don't miss that opportunity. Whereas if you're kind of watching it, you're going to have trouble doing that. Now, know your exit strategy. With this one, again, I am going to likely let this decay to 0. I'm going to let my credit go out a lot more. If we're doing this as a trade, again, you want higher implied volatility percent, but then I'm looking at getting a collection of 50% of max profit. All right, so 50% of max profit, but for me, I am most likely going to just let this decay out because I want to get that full credit. I want to keep in there. I want to average my trade out, all right? So staying with that is going to be really important for dollar cost averaging, all right? And if you own the stock and you never get hit on these puts never get put to you. Let me try and find something. Let's just go to the Tesla trade. Because I don't have a position in Tesla anymore. So when we're talking about dollar cost averaging, let's just say, we've seen this big run up, where's your entry point? Well, to me, I might be looking at, okay, if it goes back below 500 or right back down to this 400 area, maybe it's the 420 that the Elon Musk famous 420 strike. Maybe that's where you want to get in. So in that, especially with something this big of a stock, you're going to easily be able to get a nice collection at even 420 or something like that. But let's just say it was the 420. It's not going to line up with my deltas there, but you can see that if I sold the 420, I'm getting a nice collection, a $3 collection of credit on this. So that makes it work out pretty nice. Now, one of the things you might be saying is, does it fit that rule of moving the decimal 3 ticks to the left and 75 cents to the bid ask? It's not going to with Tesla, especially after the market. And it's got, you can see, massive volatility in there. So good opportunity to sell puts and things of that nature, or sell calls, because when that volatility comes out and comes back down to normalcy, you're going to be able to see those puts decay rather quickly. So it still helps to have implied volatility percent, at or near the highs. That's going to help you get further away from where the underlying is and closer to that 10% correction. But it doesn't always have to be the case. Let's just say for Coca-Cola's sake, we could pick a line in the sand and say, all right, well, I would buy Coca-Cola if it gets down to, 55 or something like that. That'd be close to that 10% correction. So I'm going to go to the 45 days to expiration. It's under $100 stock. Make sure the bid ask is inside of that 10 cents. And this is one of those cases where I wouldn't be able to necessarily sell that 16 delta And for 18 cents, I don't know if I'd even want to do that. So I'd probably go closer, maybe even to the 57 and a half. You know, if you were thinking you were going to buy this anyway, Coca-Cola, you know, selling those 57 and a halves is going to be a high probability of being in the money. You got 31% chance of being in the money at expiration. So in the next 45 days, when this expires, there's a 31% chance you're going to be in the money. All right. So that's not great odds for it being in the money, but you know, you just have to know that you got a 30% chance or a 1 in 3 chance that you are going to put this stock, or you're going to have to buy this stock at 57 and a half. But if you're looking at the overall markets and you like the environment and this is something you want to own, you know, dollar cost averaging, it doesn't always have to be on a major correction to dollar cost average properly. If you're doing dollar cost averaging over time, it will increase your overall yield in your portfolio going forward. All right. And we don't have to really worry about the earnings. So we already know that they came out with better than expected earnings and forward guidance and all of that stuff. So maybe that's why we're bullish, but we're saying, hey, you know, it's made a big jump there. I want just a little bit of a correction, maybe cover back down to here. And that's where I'm looking for. So if I were to go out here and sell these 57 and a half puts, you know, I'm going to be looking at that where, all right, get it down to a 1 lot here. And now we know that my break even is just below $57. So yeah, I would be buying it at $57.50. That's where the stock is going to get put to me at, is at $57.50. But remember, you get to keep that credit no matter what. So your break even on this is below at $56 and 91 cents. All right. So that's where my actual break even is. Because remember, the credit minus the strike location is your break even. So we'll be able to buy that, you know, synthetically at $57, let's just call it. Okay. And think about that. So if this market came down and all of a sudden at expiration, I get put the stock at 57 and a half. Well, what if it's trading $57.49 or $57.25? Well, I still got to keep that credit. I ended up buying this at 57 and a half, but think about it. I actually, with this credit, was able to buy it below where it's currently getting put to me. So I'm not too concerned about that at all. Just know that you always get to keep that credit, you know, even though it's gone below where your strike price is. You got to remember that that credit is still yours, and that still brings down your break even to where it might help it be a little bit more manageable in your own brain when you're going forward. All right. So that's what we're going to be looking at for something like that. Tesla, you know, if I go back to that Tesla trade, you know, Tesla, you know, you don't always have to pick that. I think I might have already mentioned this. I wanted to go back here in case I didn't. You know, we could be talking about the 585 puts, you know, so we get that $20. Now my break even is 565, right? It's because that's a big fat credit. A little bit below that, actually, you know, for landing in between there. And that's that 16 delta. So keep in mind, yeah, you would be being put that stock at 585, but you still got to keep that credit. So your break even is, you know, way down here, somewhere between the 565 handle and the 560. All right. So you're going to be able to buy it synthetically down there because you got to keep that credit. All right. And if it never goes down here and you've owned Tesla, well, hey, that $20 credit goes in your pocket. All right. For every contract you do, that $20 gets to go in your pocket, you know, every time you do this. And I would suggest, you know, when it gets inside of 7 days, I'd probably cover it, especially if I didn't really want to dollar cost average or I made that nice credit and maybe the market's in a correction mode, you could roll it out in time and get further out. Maybe the next month you're selling it at the 565 handle for that $20 credit. Okay, so continuously do that. Stay mechanical with it, especially when you're wanting to add stocks to your portfolio. Stay mechanical with it. It'll come to you sooner or later. It may take 6 months or something like that for you to end up buying it, but that entire time you were collecting credits. You were collecting like a dividend and you didn't even own the stock. So we're going to try and take advantage of that as we are building out a portfolio. Lowering your overall cost basis, getting that collection, you can look at it as lowering your cost basis. You can look at it as you're getting an extra dividend. You can look at it as, well, I'm just trying to dollar cost average. Kind of like what I did with, I did this with McDonald's not too long ago before we started bouncing back, as I was starting to sell some puts in there to get dollar cost average, and it never came down there. So I ended up lowering my overall basis of what I paid for McDonald's by $3 over the course of time of this McDonald's trade when it was in its little correction mode. I might as well just go and look at it. And I wasn't concerned about what this volatility was doing during McDonald's. I got caught on McDonald's up here at around 200, and you can see this whole entire time it was trading below 200 where I was. Well, I was selling calls and puts against it, just dollar cost or lowering my overall basis. When it started really spiking down, I was like selling the 185 puts, I think, in here. As I was like, if I liked it at 200, I like it at 185. It's going to get overextended here, however you're coming up with your assumption to get it, and lowered my overall basis on that. So that trade ended up working out rather well. I'm not looking to hold McDonald's long term. This is for somebody who would be, selling those 185 puts or even, the 190 puts now would be something I'd be definitely looking at doing. So if you wanted to add McDonald's, we can take a look at that. So we're going to look at about that 16 delta 200. That 200 level is a nice level for buying McDonald's, I would have to say. It's not quite a 10% correction. You could say, all right, well, if I'm looking for a 10% correction, we're looking at a $20 move down. So that's about the 190 handle. Look, something like McDonald's, you're not getting that 16 delta. It's a 6 delta, but I'm still getting a nice credit, 30 cents. That would be a 10% correction. There's only a 6% probability of that happening because remember, delta is equivalent to the probability of being in the money by 1 penny in the next or by this expiration. So we would be getting that credit, a 10% correction in McDonald's down to 190. Yeah, that seems very plausible. Not plausible. It's not very plausible if it's only a 6% probability, but that seems like a good location for me on a 10% correction. You can even go back and look at the chart or however you do it. Buying it at 190 is very near this low here. And, I would say that would be a good opportunity to buy McDonald's, right? We could even look at, let's say, Caterpillar. It doesn't have that high implied volatility percent that I'm usually looking for when I've got a bullish trade. But if I'm looking at trying to get this for a nice buy, I would say, a 10% correction. We're looking at $13 down move. That puts me at about the 120, 125 handle. Again, you're not necessarily getting that 16. We're going a little bit further away to buy Caterpillar at 120. You can even go back and check the charts. That's way down here. It all depends on your, if you don't like Caterpillar anymore and you owned it in your portfolio and you don't really want a dollar cost average, well, then I would get rid of Caterpillar out of my portfolio anyway. This is something where, you like it. You are just waiting for, somebody to make a correction in that underlying you're playing around with, right? Does anybody have any questions so far? So it doesn't always, this implied volatility percent is usually a big indicator for me when I'm trading options, trading them. But this is a little bit different. I'm using this to implement options to help me with my portfolio, lower overall cost basis, to increase the yield. There's a lot of things that we can do with the options. And my mentality with the way I'm going through this webinar right now is the fact that I want to add to my portfolio. It could be the first time you ever traded Caterpillar. You don't own Caterpillar, but you're like, hey, if Caterpillar makes, I'd like to get some, Caterpillar in my portfolio, or maybe it's Deere or something else. I'd like to get that, but I want better levels than where we are right now. If it at this point had a 10% correction, then I'd definitely be considering buying this. That would be your mentality going into this. Pretty simple, right? I mean, this strategy, or the way we're doing this, is really a lot easier, simplified. Yes, if you are doing this as the cash secured puts, and I talked about this, you're selling the 120 strike, collecting like 50 cents on it. Well, they are going to be assuming, your brokerage firm being them, the brokerage firm's going to be assuming you want to buy this, all right? And that's why they're making you put up more margin for it rather than just a trade and allowing you to leverage it. But, if you're trying to get into options, one of the natures of the beast when you're learning it is going through those levels as well for your options clearance. And the first stop is cash secured puts for something like this. You mentioned covered calls on a synthetic position. Is that another lesson? Yeah, as a matter of fact, JQ, I just did covered calls, but in the daily market commentaries, I'm going through this. So and I'm building out my portfolio according to this webinar here. I'm trying to stay away from this webinar course. So I'm trying to stay away from some of the other just trades for the most part. But what I've been doing is, practicing what I preach. I wanted to get long Disney. That was one of them. So I did a synthetic long on Disney. Now it hasn't gone my way. Your probability of success on picking and timing, buying a stock or even shorting a stock is about 50-50. That's the probabilities. All right. Probabilities are the probabilities. Well, Disney hasn't gone my way. So what have I done? I've stayed mechanical with it. I've sold some calls. I've sold some puts. I've actually only in Disney, I've only sold the calls, and I'm selling those calls at the 160 handle. So every time I get an opportunity to sell Disney calls at the 160 handle for like 50 cents or more, then that's what I've been doing, lowering my overall cost basis on that trade as we go. So I'd be happy to have somebody call it away from me at a 52-week high. That's the same thing I would do with any stock in my portfolio too. I'm not saying I would try, if I was long, 500 Caterpillar, I wouldn't do a 5 lot in the options necessarily. You're going to have to discern. Well, if Caterpillar got up to 155 right now, would I be more than willing to sell all of my cat out? To me, probably right now in this type of economic environment, I probably would. I had a 52-week high like that. And then start going in. What would I do if it got called away from me? I'd go in and start selling these puts, right? I'd start selling these puts and start building that out again, right? Because I'm selling it at 155 and I'm, then going in and selling puts at like 130 or something like that. That's where I'd want to buy it again. You just end up getting in and out of this. That's exactly how, you guys, I got started trading in college. Is I went out, I had money I had earned, and when I deposited my money, the guy at the bank was like, "Do you want to talk to our discount broker?" And I was like, "No." And then I started looking at some stocks, and I was like, "Yeah, you know what? I will." So I ended up getting IBM and like Walmart. And I was like so ticked off of myself that I bought the 2 worst performing stocks out there. Like they weren't terribly performing, but they were basically doing what it was basically back in the early 90s, they were just trading straight across something like that. It'd go up to like this level. I'd see it go up to, 145, 150, and then come back off and get down to like 140. And I was like, IBM was really, it was trading right around 100, and it'd get up to like 110 and it'd come right back off to 90. And I was telling the guy, I was like, I couldn't have picked a more sideways, stock to trade. And the guy was like, well, why don't you sell some calls against it? You keep saying it goes up to 110, you wish you would have gotten out, blah, blah, blah. And so I started selling calls against it. Got called away from me one time, and I was like, I want it back. And the guy was like, sell some puts. Okay, I'll sell some puts. Where do I sell them at? Well, where do you want to buy it? Well, I'm going to buy it here. All right, well, sell those puts. Sometimes I'd get a collection. Sometimes I wouldn't. Sometimes I would I would always get a collection. Sometimes I would keep that collection. Sometimes I'd still keep that collection, but I would end up buying the IBM. So, that's when I got hooked on trading, and that's to me the best way, especially if you have a portfolio and you're want to keep a portfolio where you like to have stock in there and stuff like that. I have very few stocks in my portfolio anymore because I'm more of a shorter term trader. But, especially for longer term, they like to have that stock in their portfolio. I would definitely start looking at covered calls on stock that you own. And then when they get called away from you, you just flip it and you start selling some puts. All right. Or, you can do it both ways as well. Like I can sell the calls at the same time I sell the puts, right? And if it gets called away from me, I'm good with that. And if it gets put to me and I'm dollar cost averaging, then great. I'm good with that as well. I have no problem doing that, selling on that strangle for it. Okay. Around a collar, or it's not a collar, but, putting that on around my portfolio to lower basis and get in and out of those at good levels. It's just like if you wanted to sell it out at 55. If Caterpillar got up to 55 again, I'd sell it. If it got down to this 30 level, then I'd buy it again. I wish I would have bought it down there. Well, if you're selling it, every single month, you would have collected credit. It still would have collected a credit. It never stayed in the money at expiration, so it never got put to you. So you'd be able to collect those credits all the way through there. All right. Yeah, a couple of times you would have, maybe if you started selling them out here, you got clipped on it and it took a dive on you. But what if you would have gone out there and just bought that stock there? You would have been in the same position as well. And I probably would have just gone out here and sold some more puts and continued to do that going out there. You would be able to get those dollar cost averages. Okay. That makes sense? So pretty simple. It's a different mentality with this than if you are trying to trade on a bullish assumption. This is really, we are trying to build a portfolio and for it long term. All right. All right. Well, if you want to learn how to trade for earnings, which is going to be, the short puts is going to be in this as well. But we are going to be talking about specific strike locations, duration, and all of those things when we're trading options, you guys. So if you've liked the way I've teached, you want to learn to trade for yourself and think for yourself, then this course is a good start as well. This is for a little bit higher risk tolerant, but if you want to start getting into trading earnings, this is great to trade earnings. I'm telling you, there's people out there that'll teach you how to trade earnings, and they're doing it wrong. And I explain some of that in these videos, why you shouldn't necessarily just limbing off the cliff with some of these guys, especially the ones that are going out there and telling you just to buy calls and stuff like that, for an earnings. If they're telling you to buy calls for an earnings, that is, the biggest no-no in my eyes, for various reasons. And I talk about that in here. So for $36, you know, if somebody told you to go out there and buy calls and you did for an earnings, you really already understand the value of that $36 because you probably already made the mistake and lost it off of free advice. So, like I said, if you liked the way I've taught, if anything I've done resonates with you, if you guys want to start to learn to think for yourself, then take advantage of this. The URL is right up here. I'm going to throw it over in the chat window right now for the rest of you guys. If you want to do it on the hot link, it's in the chat window. So you'll be able to get direct access to that. Also, here's a phone number, 310-598-6677, or email it at trading@protraderstrategies.com if you have any questions about this. But basically, I cover all of the best strategies I find for earnings in this and the specific rules, kind of like I did with this short put. You know, if you guys have seen the other short put video where I'm talking more about directional assumption and high implied volatility, you can see that some of the rules for adding this to our portfolio or adding stock to our portfolio are a little bit different here. All right, so take advantage of that for 36 bucks. There's probably 10 hours or so of content, so definitely worth your time and money for that. And you have just about to the end of time to watch those and take advantage of that. All right, so without further ado, I want to thank you guys all for staying with me in this webinar. In later webinars, I'll drill down on different option components when and where I find them appropriate. There's also the link. It's going to have to be punched into your URL. Thanks again for watching, and contact us at 310-598-6677 or email me at trading@protraderstrategies.com. All right. That's all I got, guys. Other than if you can't take that, take it easy. Bye for now. Take care, you guys.